tens of billions of dollars moving out of the country, it's bound to have some impact on, how other banks behave.
Mm-hmm.
And so I think that's one of the issues. One final point spoken to, Ron. You mentioned that if you look at the numbers, foreign borrowing of banks didn't fall that much, but that's partly because of the swaps that were extended by the BOK and the Ministry of Finance, which substituted public borrowing for private borrowing. But essentially, private foreign borrowing fell by about 50 billion or something, and then they provided about 50 or 55 billion in swaps. So when you look at the numbers that way, you see, well, bank borrowing didn't fall, but that's because the BOK stepped in very quickly and used the Fed swap line and the reserves to get that way.
Thanks. As to we do in the study, we talked some about the branches, and that certainly was, my understanding is that had an important impact on the Bank of Korea's thinking about this. And I think you're right, too, on the exchange rate overshooting. I don't think was incredibly costly. I think that's exactly right. So I basically am trying to try out intellectually the case, because I didn't want to just say policy's perfect. I had to find some things to raise some questions about. And I don't have many chances to say there should have been more rather than less in the benches. I actually do believe it would have been better to have had some more, but you're right, it wasn't disastrous, and it wasn't like entirely stupid thing not to intervene. It wasn't anything like the equivalent of the mortgage lending.
All right, we have, let's see, Ji, I know you have to leave earlier, so why don't we give you priority?
Almost it's a highly related footnote that conversation that you were just having about Bank of Korea staying off the exchange rate market. I think to make a little aggressive case, I think there is even somewhat intangible benefit of Bank of Korea having stayed off the market a little, probably a little excessively, on this side, which is that there is a little stigma associated with most emerging market central banks that they will come to the rescue at the first sign of trouble in the foreign exchange market. Then you know that this creates incentive problem of private sector not hedging the back. So for that, so in terms of incentives or signal to be sent to the private sector, and also something like this credibility of central bank as a sponge inflation targeter rather than behind the door exchange rate targeter. That could have been a bit useful tactical move to have at the moment.
Let's take the other two questions to respond.
Yes, I don't want to belabor this point, but I think it's also, and you did nuance this, but when you look at the reserves data, clearly Korea was actually one of the most aggressive in terms of trying to defend its currency. It's a 40 billion or so loss, and I think most emerging economies, including India and others, they decided, well, it's a global financial crisis, they're not going to win this game if we try and defend, so that's why sort of I think that's, and plus commodity inflation had due at that time, so there's not that pressure on the supply side, so why not let the currency depreciate? So I think that I think made some sense. Two quick points. One was about this issue of financial liberalization. I think Subila's point about foreign versus domestic banks extremely important. He's talking about lessons from the crisis. Well, since the last Asian crisis, if you look at the data, among the number of initiatives taken was financial liberalization or opening up of domestic sector to foreign bank entry. Indonesia and Korea were the most aggressive. Indonesia's foreign bank entry was actually more so within the region, but Korea is much more international. And to some extent, when you look at data on leverage of banks, etc., Korea stands out much more than a lot of the other Asian countries. So I think it has a bit to do with this. So it's not just an issue of the macro side debate about capital controls, reserves. It's also in terms of the financial institutions, the degree of degree of openness of the financial sector to foreign banks, etc. I think the issue that a lot of emerging economies are dealing with regard to that point is branches versus subsidiaries, right? I keep telling the story, but I think it's a very important one. Very quickly, if you go to when I was in KL a few months ago. In KL, in Asia, the AIG version is AIA, right? And so I didn't know about it. I said, "Oh, is this any relation?" They said, the central bank deputy governor said, "Yeah, this is the Asian subsidiary or whatever of AIG." And she said, "Well, thank goodness that this was a few months ago, thank goodness we got AIA to become a subsidiary as opposed to a branch. The difference being that subsidiary, now you're regulated completely by domestic financial regulations. And so the big issue now, branch versus subsidiary, I think is an important debate going forward. Just one very quick point about reserves. What is your view on this just basic notion of reserve adequacy? You mentioned this a bit, but I think it's important to when you did your calculations about the extent to which there's capital outflow during the Asian crisis, etc., and you mentioned this point, but I think most of that analysis that you did was based on net capital flows. So the idea, therefore, being that there may not be as much net capital outflows in Korea, or there hasn't been this time around, but I think in terms of gross terms, they may have been, I don't know. So the point is, when you look at all those calculations, one should really be looking at gross, not net, unless you can argue, well, when there's outflows, there's going to be perfect coordination of inflows, and so net matters. But there's not going to be perfect coordination of inflows. There are two different parties doing the different things, right? And so I think it's a cross that's important.
And we'll take Rob's question before.
Mine's more general. You put forward the idea that Korea has relatively well managed its exchange rate policy by both a managed float and also by an inflation target. Vis-a-vis the Chinese RMB, which of course has been pegged against the dollar, how does that impact on their competitiveness?
Oh, it hurts. So, I mean, there is, I think Korea has a strong interest in China appreciating. I don't know how much moral suasion the government feels in a position to put on it. Of course, I think China has a strong interest in, strong aggregate interest in the renminbi appreciating, but there are particular sectoral interests that are politically influential sort of against it. But I think, yeah, I mean, Korea has a strong interest in encouraging China to appreciate, I think, on that. That is an incredibly frustrating issue, of course, because one doesn't have much leverage on it. And as far as I can tell, intellectually, most of the Chinese government officials sort of accept the argument that it's sort of like, yes, we should appreciate, but not now, kind of thing, because the short-run politics is going in the opposite direction. Issue, we're doing, Sam Schreier recently finished his dissertation at Claremont. Has been trying to look at some of this more with the sudden stops. There are much stronger than I would have thought empirical regularities between the inflows and outflows, which we need to understand. Well, I need to understand better as whether it's statistical artifacts or how much they are genuine linkages. I mean, like, it is clear to some extent that the borrowing of dollars from the Korean banks, was related to Korean investment in foreign portfolio investment. So I think there is some degree of, I think, statistical regularity, but it certainly should be less than 100%. And I think that there's a huge amount of important research. Yeah, I mean, this was a problem too, with just, I mean, we now sort of sudden stops have become a big buzzword, but a lot of the early work really just looked at changes in net flows and didn't, the image of the sudden stop is it's foreign investment stopping to come in. But a lot of the early work didn't distinguish at all between that and capital flow. And so some of the work